McGraw-Hill Professional presents The Income Factory, an investor's guide to consistent lifetime returns. Written by Stephen Bavaria. Narrated by Fred Filbrich. Introduction. Wealth without the drama. The message most investors receive constantly from their brokers, advisors, cable channels, and other business media is that success depends mostly on placing winning bets on the right securities. Then you have to follow their progress 24/7, always being alert to signs of trouble that may require you to bail out or change course at a moment's notice. Whew, that's a lot to worry about. No wonder so many average investors are stressed out and confused, or throw up their hands and buy overpriced annuities and other heavily promoted products and services that promise to relieve them of the angst and insecurity of investing for their own futures. While investing can indeed be all of that for many people, it doesn't have to be. I know because over the past 30 years that I have been actively investing for my own retirement, I have developed an alternative way to think about investing. This approach, 1, emphasizes things that we as investors have more personal control over, and 2, does not require such a heroic achievement in terms of earnings or stock performance as do typical growth-oriented strategies. I call my strategy the Income Factory, to focus attention on the actual job I expect my investment portfolio to do. That job is to produce a constant river of cash, that is income, in the form of dividends and cash distributions that can then be reinvested in new securities, whose job in turn is to provide additional income in the future. As that new income is reinvested and begins producing even more income, my river of cash continually grows. We discuss the math in more detail later, demonstrating how the cash buildup increases year after year at a fairly predictable rate, depending on the percentage yield our securities are paying us. The cash output from our income factory will double, then redouble, and then redouble again, continuously over the course of one's lifetime. A 10% yielding portfolio doubles and redoubles about every 7.2 years. An 8% yielding portfolio doubles every 9 years. A 7% yielding portfolio almost every 10 years, and so on. Notice I haven't said anything about the securities' market prices going up or down. That's because an income factory's output, that is the cash it produces, which is constantly reinvested to produce more cash, does not depend much on the growth rate of its individual securities, or even on whether they grow at all. Instead, it is the reinvestment and compounding that provides the growth in the income stream, not any required growth in the dividends or market value of the assets in the portfolio. The portfolio, of course, grows in value over time, not because the individual securities rise in price, but because there are more of them, as we use the cash we receive monthly or quarterly to buy more income-producing assets to add to our factory. For those of us who grew up in an investing environment where market appreciation was the be-all and end-all, embracing the income factory's growth without growth stocks philosophy can be a big step, mentally and even emotionally. To make the leap of faith required, it is helpful to spell out and understand how growth actually occurs in a traditional investment portfolio. First, note that the goal of most long-term investors, including me, regardless of what investment strategy we follow, is to earn an equity return averaging about 8% to 10% per year. We picked that target because 8% to 10% is approximately what returns on stocks have averaged over the past century. Some equity investors do better than that, and others do worse. But if someone can match that average or even come close to it over a lifetime of investing, they and their dependents, and eventually their heirs, should be pretty happy later on when they reach and surpass retirement age. The big question is how to achieve that 8% to 10% return. Return, or total return, as it is often called, has two components: cash received, dividends or distributions paid by your securities, plus market price appreciation or depreciation. Cash received is real. Market price appreciation or depreciation is theoretical, paper profit or loss, and only becomes real when you sell the security and harvest the gain or loss. In traditional investing, You buy stocks that typically pay dividends of anywhere from 1%, sometimes 0, to 4% or 5%, and then depend on the company to make up the difference between that and your 8% or 10% target by increasing its earnings and dividends from year to year by the amount of the gap. The lower the cash dividend a company pays, the more its stockholders depend on future growth to reach their target earnings level. That's why a company that pays a paltry 1% or 2% dividend had better have serious growth prospects to make up the difference. A mature company, like a major utility or industrial blue chip, that pays a more generous 4% to 5% dividend, has less of a gap between its dividend rate and its stockholders' 8% to 10% income target. But it is still expected to make up that 4% to 5% difference in growth year after year. With our income factory strategy, we don't have a growth gap to worry about, since reinvesting and compounding the high cash distributions we receive achieves our total return target rate without requiring any additional market price growth. Our overall factory will in fact be worth more over time, not because prices of the individual securities grow, but because we can constantly use our cash income to purchase more of them, thus expanding the factory. To better understand this, think of a real factory. When Ford Motor builds a new automobile plant, the only ones who care about what the plant is actually worth, that is, what Ford could sell it for, from day to day or month to month, are the accountants. Everyone else at Ford focuses on how many cars and trucks the plant produces, and how to increase that output going forward by reinvesting, adding new machines, and so on. The market value of its plant is not relevant to Ford, since its business isn't buying and selling factories, it's making and selling cars. When we embrace an income factory strategy, we are acknowledging that our long-term investing goal is to create an income stream for ourselves. Owning stocks, bonds, funds, or other investments is a means to that end, which is creating the continually growing river of cash that we can retire on or use for other long-term goals. The income factory that produces that river of cash obviously has a very real economic value to us. But the price the market attaches to the income factory from day to day or even month to month is largely irrelevant to us as long-term investors. Later chapters get into more details about income factory strategies and how to set goals, implement a strategy, and monitor its success. We also discuss certain asset classes that are particularly suitable for this type of investing. 3 features of our strategy are especially attractive and should be mentioned here, even though we discuss them at length later on. One is the recognition that an income factory's earnings stream actually increases faster when stock markets are flat or dropping than when they are rising. This is intuitively difficult for many people to accept, since it flies in the face of our natural tendency to always assume that rising stock prices are a positive and make us wealthier. The reality is that for an income investor, your income stream doesn't drop just because stock prices do. So your river of cash buys more when securities have dropped and are on sale than when they rise. By being able to buy even more new securities, machines for the factory, because their prices have dropped than you would have been able to if prices were flat or had risen, you boost your compounding rate higher than it otherwise would be. The extra 0.5% or 1% you pick up by reinvesting through down markets over many years can eventually add tens of thousands of dollars of additional income. When Einstein said, reportedly although never confirmed, that compound interest is the 8th wonder of the world, this is what he would have been talking about. The second feature I like about our income factory strategy is the greater sense of security it gives us during periods of market turbulence. It is hard for many investors to sit through market slumps or bear markets and only collect the 2%, 3%, or 4% current yields that typical growth portfolios pay, while watching market prices fall. An income factory strategy, by employing investments and asset classes that pack a full equity return level of 8% to 10% into their cash distribution, makes it psychologically easier for investors to keep the faith and not feel the urge to get trigger-happy and bail out or take defensive actions that might seem like a good idea at first, but are costly over the long term. In Charles Ellis's classic book on investing, Winning the Loser's Game, the author compares investing for many people to amateur, not professional tennis, where he says most points are lost through bad shots as opposed to being won as a result of good shots. Ellis shows how this is also true in golf and even in war, where avoiding doing the wrong thing is the key to success, much more than actually doing the right thing. In investing, doing the wrong thing typically involves losing one's nerve and selling out at what turns out to be a low point or even the bottom of a market slump. Such mistakes are often compounded by then being on the platform and missing the train, when market prices turn up again, as history has shown us they eventually do. The difference of seeing, feeling, and touching the cash each month that you can reinvest to create your own income growth, and especially to be able to do it all through the downturn itself, provides a sense of control that helps income factory investors fight off the impulse to do something that can involve turning temporary paper losses into permanent real ones. Numerous studies demonstrate that buying quality stocks and holding them through thick and thin over many decades is the most effective way to achieve stock market success. But history shows many investors do not have the will forces and intestinal fortitude to buy and hold through market downturns. In this way, the income factory suits the psychological and emotional needs of many investors, as well as meeting their long-term financial objectives. My other favorite feature of the income factory is that it allows, even encourages, what I call non-heroic investing. Think about the traditional dividend growth stock that pays cash dividends of 3% to 4% or less, and has to then grow at 5% or 6% each year to make up the difference for an overall 8% to 10% growth rate. Since our entire economy is likely to grow at about 3% per year, we know most companies can't be growing at almost twice that rate, unless they are like the children of Prairie Home Companion's mythical Lake Wobegon, who are all reported to be above average. That means a typical growth investor expects all the stocks in his or her portfolio to have above average growth compared to the rest of the economy. Otherwise, why would their stock prices grow any faster than the economy at large? That to me is heroic investing, where you are expecting the securities you buy to substantially outperform their competitors and the economy in general. For that to happen, they have to be great companies, and you have to be a great stock picker. Securities in our income factory don't have to outperform. All they have to do is keep making the interest and dividend payments they already make. I consider that non-heroic investing. If it were a horse race, the heroic investments that expect above-average growth over time are the equivalent of betting on horses to win the race, or at least place or show, meaning they have to do much better than the average horse in the field. Our income factory horses only have to finish the race. That is, stay in business and make the interest and dividend payments they currently do. Which is the safer bet? Betting on specific horses to win, place, or show, or betting on the entire field of horses to just finish the race? By now you may be asking, sounds good, but if it is so obvious and straightforward, how come nobody else thought about it? Fair question. I think the answer is that it is easier to think outside the box about something if you have never been put inside the box to begin with. I never had any formal training in investing and never learned about traditional investment strategies until later in life. By then, I'd already been an international banker and learned about credit and risk from the perspective of a lender, not a stockholder. So I was totally comfortable with the idea of making money via fixed income payments, that is, that stayed the same and never grew, rather than through stock price appreciation. For me, it is all about math and probability. Which stream of payments will grow faster or more reliably? One that depends on heroic efforts on the part of companies to increase their cash flow over time, or one that relies on relatively non-heroic efforts by companies to merely maintain current cash flow levels. Later, I did a stint as a journalist at a financial magazine and learned how to write about complicated financial topics in plain English that non-experts could understand. Hence, my interest in using simple analogies like income factory or betting on horses to merely finish the race instead of having to win, place, or show, to explain the difference between growth investing and an investment strategy based on cash flow compounding. After that, I spent my third career in the financial markets, working on products to assess the risk in corporate loans, private placements, and other non-public securities, which opened my eyes further to the risks and opportunities outside the traditional equity mainstream. Finally, My experience during the great crash of 2007-2008 demonstrated in my own portfolio and in the financial markets generally how so many healthy assets that kept on pumping out cash flow just like the Energizer Bunny still dropped in market value to 50 or 60 cents on the dollar. This seared into my consciousness the idea that market price and paper profit or loss often have little to do with the real economic value of an asset, and that ignoring market prices while you keep your head down and continue to clip your coupons and reinvest through the storm can be critical to long-term success. But you have to be invested in the right assets for the right reasons and with the right strategy. The Income Factory is all about how to do that. Chapter 1. How to use this book. Readers may wish to think of this as essentially 3 books in one. In the first book, which runs through Chapter 5, we describe the overall philosophy and strategy of the Income Factory, including 1. The basic idea that producing income is the primary purpose for most people's investing activities. 2. That reinvesting and compounding high cash distribution yields to produce income growth is every bit as effective as pursuing market price growth. And 3. That there are other less stressful and more predictable ways to generate an equity return than actually holding equity. After describing the Income Factory theory, the first book concludes, in Chapter 5, with a detailed look at the issues investors might consider in deciding whether an Income Factory strategy is appropriate for them, given their financial goals, investment style, risk-reward comfort level, and tax status. Many investors may decide at this point that they don't need to read Book 2, Chapters 6 through 9, which provides lists of possible candidate funds for assembling an income factory, including model portfolios of different sizes and risk-reward profiles. Once they grasp the philosophy and strategy, they may well conclude that they have all the information they need to go out and implement the strategy on their own. Other readers, not yet prepared to do that, may find the candidate fund list, model portfolios, and other earnings enhancement ideas in Chapters 6 through 9 to be helpful starting points. The third book, Chapters 10 through 14, provides an in-depth discussion of the risks and rewards within the equity and fixed income sectors, for readers who wish to have a more thorough understanding of the bets we are making when we invest in various asset classes, especially the ultra-high-yielding ones we may choose to hold modest positions in to boost our rate of return. Finally, in this chapter, there is a section on Income Factory maintenance with links to updated model portfolios and fund candidate lists on the Seeking Alpha blog site, which readers can access by pasting this address into their browser: seekingalpha.com/author/Stephen-Bavaria/instablogs, or if they prefer, searching online for Stephen Bavaria or Income Factory to find links to related articles and blog posts. The Income Factory has been written for an audience whose members may have a wide range of knowledge about and attitudes toward its subject. Readers may be at different places with respect to learning about, considering, accepting or rejecting, planning to implement, or actively employing an Income Factory strategy. The purpose of the book is to provide each reader with the insights, information, or tools they need, regardless of where they are on that spectrum. There are 3 main themes underlying our Income Factory strategy. 1. Producing an income stream is the primary purpose of investing for most people, and the public's fixation on the market value of the assets producing that income stream is a more recent phenomenon. The switch from focusing on income, which is more steady and predictable, to today's constant emphasis on market value has helped foster an enormous financial media and investment management industry, but at the cost of increased stress and angst for average investors. 2. We can grow our income stream and earn whatever target total return we set for ourselves, just as effectively through cash distributions as through market appreciation. In other words, math is math, and we can earn a 10% equity return just as easily from a portfolio yielding 10% with 0% growth as from one yielding 0% with 10% growth. 3. Combining those 2 concepts, we can easily conclude that we don't really need to hold equity to earn an equity return. If we can find other assets capable of providing that 10% yield we can use to reinvest and compound our income stream. Surprising as it may seem, The ideas and conclusion embodied in these principles that you can use high-yielding, non-growth assets to build income and wealth over the long term incurred stiff resistance from many writers and readers when I first introduced it on the Seeking Alpha website about 5 years ago. Despite the math being obvious and irrefutable, there was an emotional reaction from many who were convinced that growth was inconceivable and not authentic without growth stocks. Much of that initial resistance has been overcome, at least on the Seeking Alpha site, where over 9,000 followers and other readers continue to express their support for at least their open-mindedness toward these principles that underpin the income factory strategy. Chapters 2 through 4, plus the introduction that you have already read, cover these themes and provide a top-down overview of the entire income factory strategy and the reasoning behind it. Chapter 2 lays out the intellectual foundation, presenting an overall rationale for how and why we invest, as well as an alternative way of measuring our own investment success that differs from the model that has been adopted, out of necessity rather than because it is logical, by the professional investing industry. Chapter 3 goes on to describe how Mr. or Ms. Market translates economic performance into stock price movements. It explains how traditional investment strategies rely on the market to recognize corporate earnings and dividend growth and to convert that into equity prices, with considerable uncertainty about timing and a great deal of wishing, waiting, and hoping for it to happen. Then we introduce the income factory's approach of focusing on cash income rather than fixating on market price movement as an alternative many investors will find less stressful and easier to adhere to over the long term. In Chapter 4, our focus shifts from describing the theory to being more of a how-to manual for readers who wish to further understand income factory principles as a prelude to incorporating it into their own investment strategy. We get a bit down and dirty, very briefly, in explaining the math underpinning the reinvest and compound approach to investing, even providing a link to a spreadsheet so readers can run their own yield growth combinations and demonstrate it for themselves. Then we describe the various risk factors involved in both traditional growth investing and the income factory, and even introduce the option of an investor keeping a foot in each camp by blending the two approaches into an income factory light, IFL strategy, that achieves some of the benefits of both. In Chapter 5, we turn to the practical aspects of designing an income factory that fits a reader's personal needs. That means considering financial goals, investment style, risk tolerance and comfort level, and the investor's tax situation, among other factors. At this point, many readers may say, "Thanks, I get the idea. I'll take it from here." In other words, once they understand the theory and strategy, many investors will be perfectly capable of doing their own research and selecting the machines for their income factory on their own. But for those readers and investors who would like further practical ideas and direction, Chapters 6 through 9 contain lists of candidate funds for consideration, as well as model portfolios tailored to various risk-reward preferences, investment styles, and tax situations. I wish to caution readers that these lists of funds and other securities, indeed all the ideas expressed throughout the book, represent my good faith opinions at this point in time. I believe the income factory is an effective strategy, or I would not have committed most of my own savings to it, or be relying on it to fund my own family's future. Nor would I have been doing it so publicly as I have been on Seeking Alpha, publishing the results like clockwork every quarter for many years. Eating my own cooking in public, I call it. Nevertheless, we must all realize there is no guarantee that any of the ideas, opinions, strategies, or specific funds or securities outlined here will lead to successful results in the future, either for myself or you. They represent insights I have accumulated over 50 years in finance and investing. And while many of the ideas have served me well in my own investing over many years, there is no assurance they will do so in a highly uncertain future. With that understood, let us move on to specifics. In Chapter 6, we introduce a candidate list of 68 funds from 11 different asset classes, running the gamut from senior loans, high-yield bonds, and other fixed-income securities to more equity-oriented funds of various kinds, including real estate, utilities, master limited partnerships, MLPs, and equity option funds, all of which have in common their propensity to pay higher yields than ordinary equity investments. From that candidate list, in Chapter 7, we present a number of model portfolios, some moderate in terms of their risk-reward characteristics, and others more aggressive, that investors may wish to use as is or as a foundation for creating their own unique portfolios. The model portfolios allow investors to start with as few as 10 or 12 funds with moderate risk-reward profiles and the expectation of current annual distribution yields of about 8%, and to graduate up to larger and more aggressive portfolios with yields in the 10% range. Although the funds on the candidates list and in the models are believed to be solid funds from respected fund families, we urge readers to do their own due diligence and check various investment sites for up-to-date pricing and yield data, as well as the most recent news and opinion articles on each fund. I will be publishing routine updates of the model portfolios, available on the Seeking Alpha link cited elsewhere in this chapter. Chapter 8 begins with the observation that some investors may decide to stop reading right here and just get on with their investing, using the model portfolios as a starting point. But for those who wish to shoot for greater returns, the chapter describes ways to soup up their income factory with higher-yielding funds that also present a higher risk-reward profile. It describes the potential impact even a small increase in yield can have on our income growth over many years, while also explaining the trade-off in terms of additional downside risk. Chapter 9 presents other variations on the basic income factory theme, introducing a model portfolio for those who wish to pursue the IFL strategy mentioned earlier, as well as one for taxable accounts. The next 4 chapters involve a deeper dive into the credit and fixed income markets. They should be of interest to investors who really take seriously our idea of earning an equity return without investing in equity and want to understand in detail what that means and how we expect to do it. In these chapters, 10 through 13, we examine various asset classes, both fixed income and equities, to see what bets investors are actually making when they invest in them and how they are compensated for making those bets. We begin by looking closely at the interest rate, credit, and equity bets that are embedded in stocks, bonds, and loans. We note how stockholders, whether they realize it or not, actually take all the risks of the loan and bond investors above them, as well as the additional existential risks of owning equity and being at the very bottom of the food chain if the company ever stumbles. This can come as a great surprise to equity investors who are happy to buy mid-cap and small-cap stocks, issued primarily by non-investment grade or even unrated companies, but say they wouldn't be caught dead buying so-called junk bonds, which are issued by the same cohort of companies and are, in fact, less risky than the stock, which is worthless if the debt above it defaults. In Chapter 12, we examine senior secured corporate loans, a solid building block of an asset that plays a key role in our income factory portfolio. Loans are an attractive investment in their own right, and in Chapter 6, we include loan funds as one of the 11 asset classes in the candidate list of funds used to build our model portfolios. But loans are also pooled into more complex special-purpose vehicles called collateralized loan obligations, CLOs. Although CLOs are the principal buyers of all syndicated corporate loans, until recently they were limited to the portfolios of large institutional investors. CLO equity is still in its relative infancy as a retail investment, but a handful of funds specializing in CLO equity have appeared on the market within the past decade. They offer an opportunity to income factory investors willing to undertake the due diligence required to understand them, as well as take the additional risks that come with investing in ultra-high-yielding asset classes. The CLO equity funds first mentioned in Chapter 8 are among our ultra-high-yielding vehicles of choice for enhancing, that is, souping up, our risk-reward profile beyond the standard 10% equity return target of our aggressive portfolio models. Our goal in adding ultra-high yielders is to find that risk-reward sweet spot where we can boost our overall reinvestment and compounding rate by enough, 0.5%, 1% or more, to materially increase our ultimate income stream a decade or more in the future, but not so much as to cause serious downside damage if the ultra-high yields fail to sustain themselves and turn into more modest yields. That means keeping our total of ultra-high-yielding assets modest and, to the extent possible, well diversified. Chapter 13 is for those readers who are intrigued enough by CLOs that they want a more comprehensive, yet still reasonably straightforward description of them, how they work, and what issues to be aware of in investing in them. Readers who find all 4 of these chapters to be interesting, especially the more esoteric aspects of credit risk, the interplay between default, recovery, and ultimate loss, and how all of it affects ratings and pricing.
Sample complete. Ready to continue?